Happy Friday, everyone. This is Ben Adams with my co host, Adam Lang, and we are back with another episode of the Pursuit of Progress podcast. And today we're going to continue our deep dive into real estate. And Adam, what exactly are we going to be talking about today?
Yeah, guys, excited to be back on another episode. We're going to be continuing from our last week's episode where we're doing a new approach. We're doing a series on going, a mile deep on specific areas within real estate investing just to shed some light on, what's been working for us, for some of our friends and clients and just sphere that we are talking with on a daily basis. So, last week, as a recap, we talked about kind of two things. We talked about just understanding the different types of real estate investments, small, large, multifamily, fix and flips, stuff like that. And then we also went a little bit more in depth on just goal setting and understanding how different types of investing strategies require different levels of output regarding what kind of work you're putting into it personally, as well as the team that you might be involving yourself with in that investment. So that was last week. And then this week, we have two additional topics kind of going further along down the path. And these today are going to be about researching the market and also financing these different types of deals. So, starting with just researching the market, I think Ben is a great person to share some personal experiences, challenges, successes with how he's been able to successfully do this, investing as a Colorado native, but investing out of state, basically short term and midterm rentals. So, Ben, tell us a little bit more about what you've been up to the last few years and how you've been able to research markets outside of Denver.
Yeah, that is a great question, and I'm so excited that you asked that. And that's exactly right. I think that's one reason why you want to identify first what type of properties you're looking to invest in, and then what the overall underlying strategy is going to be. Because once you identify those two things, it's then going to give you clarity on some appropriate markets. Now, my personal story, for those of you that don't know, I went through a divorce in 2018, and how I got started in my real estate journey is my ex-wife. At the time, she had moved back to Tucson, Arizona. And so the vision for myself and the kids is that we were going to be going down to Tucson, Arizona a couple times a year to spend some time with her. And I also knew that Tucson was a really pro market, really strong market for short term vacation rentals because government laws are very pro host or very pro short term. There's not a lot of government interference from a city, county, or state level. Tucson also has a lot of just incredible amenities. There is a very large university down there, the University of Arizona. It has incredible golf. It has the world's largest gem show that lasts from the second half of January into the spring. There's a lot of snowbirds are coming down from all parts of the United States and Canada. And so it checks a lot of the boxes that you want to see for a short term vacation rental market. And so my initial goal was to find something that my family and I could use so they could spend some time with their mom after our divorce. And then something that I could also use as an investment when I wasn't using it for family purposes. And that's how I got started. I bought my first property down there in 2019, and here 5 years later, I own multiple properties down there. I've learned a lot. I've been able to build out a team. We have everything from a property manager to cleaners. Um, I have a pool person who comes every week to maintain the pools. I have a pool repairman who is someone entirely different. Landscapers, handyman, electricians, roofers. When you're managing something remotely, I would say having a really sound, competent team is almost even more important than finding, a great property. If you find a great property that has great potential, it doesn't mean anything unless you have a great team. So both of those items are just very, very important. And so far, I love it. Since then, I've expanded with some different strategies into other markets. But yeah, I just want to hand the mic back over to you so you can share any of your thoughts or ask any other questions.
Yeah, that's all really good info to just to kind of digest there. I think we'll go even more in depth on this building a team concept and how that's, I think, probably one of the most important strategies that you have some control over to really set yourself up for success. But the only thing I would just talk a little bit more on my end from when I'm talking about researching the market is, going back to what strategy you have before ever even starting to research the market. So just as an example, let's just say that I've got a total budget where, after the deposit I'm putting down on the loan and all that stuff, that, basically I've determined that $500,000 is the ceiling for what this investment property can be purchased at. If
Hmm.
that's my goal, and it's also a goal to have a fourplex, for example, where I can either maybe live in one unit, rent out the other three, or maybe it's just for rentals. A city like Denver, that's going to be pretty much nearly impossible unless you're going outside the maybe Pueblo, or, significantly outside of the Denver area. So having that kind of that strategy at the very, very beginning of all of this will help you determine when it comes time to researching different markets. So going off that same example, that would be a great opportunity for me to start finding places like Tucson, or maybe down in Tulsa, Oklahoma, Sunbelt states. So just really understanding, again, just your strategy, and then that's going to start that very first step towards this market research and understanding where you want to maybe go. Um,
Yeah, and let me bring up another point that touches on what you were just saying. I think there's a mentality out there, just from what I've observed, that you can't start investing in investment properties until buy your first home. And so I see so many people that have this mentality, well, I have to go buy a primary residence. And after I do that, then I can go start investing because it makes more sense to go buy a home to live in and then start investing. Exactly to your point there a minute ago, like right now in Denver, there is an affordability crisis, not just in Denver, but a lot of these other big cities because home values are at all time highs. Interest rates are at 20-year highs. And so I still believe very, very strongly in real estate, short term, medium term, and long term. I believe that ownership in real estate is very important. But there might be a scenario where someone it may not make sense to buy a primary residence, and it may make more sense to go straight into investing, where you rent your primary, or maybe you live with your parents, but then you go buy that investment property and go straight into investing. And that can, depending on the individual's goals, their circumstances, that can actually make sense. And so I just want to remind everyone that you can go buy an investment property even if you don't own your primary residence.
hmm Yeah, very good point. I know there's very mixed, opinions on this kind of stuff with some of the more influential people on social media. Two that immediately come to mind are Dave Ramsey and also Grant Cardone, if you guys are familiar with either or both of those people. But, Dave Ramsey has one very specific, and Robert Kiyosaki as well. Yep. But with Dave Ramsey, very big on limiting the amount of debt you have. Grant Cardone, basically the exact opposite, really understanding that debt can be your friend if you're using it wisely.
Hmm.
But just kind of going through those two varying outlooks on real estate investing. And Grant Cardone's very famously known for even saying that, as he's coming up on being a billionaire. I think maybe he already is at this point. Still renting his primary residence at times and only
Hmm.
putting his money towards investment type properties.
I know it's interesting because their viewpoints are polar opposite, but you want to know what's crazy? They're both right. And the reason that they're both right is because they have picked a strategy that works for them. And that's what's so important. That's what my message is. And that's what you're talking about. You have to pick a strategy that is going to be right for you. There's so many different ways to win in investing and real estate. And hey, listen, you can win in investing and not even own real estate. That's certainly possible. Someone like a Grant Cardone, Robert Kiyosaki, they're very real estate focused. But you have a lot of other individuals who have had tremendous success with real estate or with investing that don't even own real estate. And
hmm
so, really, just identifying what are your goals, what are your strategies, how do you want to go about this, and that's why I always talk about when it comes to personal finance. There's all these different things that are important. Pay yourself first, learn how to invest, don't spend more than you make. All of those are incredibly important, but the number one most important thing is having a vision. Because if you don't have a vision, your vision is what creates the blueprint and is the architect for the rest of your plan. And so if you don't have a really sound, strong vision, that you believe in, you're not going to have something that is going to give you that daily purpose and drive to go execute. So, number one, create a vision for yourself and a strategy, and then start to take action and go execute on it.
Love it. And with pretty much every investment, but I think especially with real estate, there's obviously different ways to make money with real estate investing. The appreciation over the time that you own the property, adding value. There's all these different ways, tax benefits, but the key
Hmm.
is, and I always come back to just this quote. Don't wait to buy real estate. Buy real estate and wait, and just understanding that this is a long term play for the majority types of real estate investing, and
Yeah.
having that clear understanding that the earlier you get started, the more you can benefit and reap the rewards of that amount of time that you own the property. So if you are somebody that maybe lives in Denver like we both do, and you're just really beating yourself up against the wall, you're beating your head up against the wall because you just feel like it's unattainable to buy a investment property in Denver, when we're talking on the last episode about how a duplex could be still $1 million or more.
Yeah.
Going to other states and realizing it's not that much different, even if you don't live where you can see and touch the property, even if it is in a different state, getting over that limiting belief and starting to look at other places such as, again, Tulsa, Sunbelt states, places where you could literally buy a duplex for $100,000 and just get your toe in the water, in the pool, just start, getting a little bit of real life experience on a smaller scale. Because the thing that I love more than anything about real estate investing is it's a very scalable business model. Ben's been
Yeah.
able to prove that with his short-term vacation rentals. It's the hardest
Hmm.
investment is the first one. Once you've got that little bit of momentum going, buying one or two more units a year, all of a sudden doesn't seem like that overwhelming of a goal or of a task to make reality. So just kind of understanding, again, I guess a long-winded thing I'm trying to say here is just understanding the value of time. And the earlier you start, the more value you can build up into that property over time, and have several other types of rewards as well, like tax benefits and all that other stuff.
Yeah, and Adam, I am so glad that you referenced that quote because that's one of my favorite quotes as well, and it's something that I really believe in. And this is the conversation that I'm having with my customers and my clients and those that are really interested in investing. Something is happening right now with just our overall economy and inflation here in the United States. When you look at our expenses relative to how much money we're earning as your average consumer, expenses are dramatically outpacing wage growth. And so, what that means is in all of these different areas, it is getting more costly just to live. When you look at housing costs, for example, today in 2024 compared to 1994 as a percentage of pay, it is dramatically more expensive to own a home or just even rent than it was 30 years ago. To drive your car, it is more expensive. To buy groceries, and that's because all of these costs are outpacing wage growth in our society, in our economy. And so what's happening is it is more important than ever. Talking to young folks right now, investing used to be something that was optional, depending just on your goals, because you think of, our parents' generation or Gen X or baby boomers. A lot of them are getting, Social Security. A lot of them are getting pensions. They are having different retirement benefits that are not going to be available for millennials and Gen Z, and that's just the reality. And then not only that, the cost of everything are going higher. And so the only way that you can make sure that you don't get left behind is by owning assets. And a great asset to own is real estate. As we've learned, everyone's talked about inflation the last 2 or 3 years, right? Well, what's one asset that is usually immune to inflation? A lot of times it's real estate. And when you look at how real estate has performed over the last 2 or 3 years compared to inflation, I mean, it's been incredible. So for people that have owned real estate, appreciation in the property has dramatically outpaced inflation. And that is why you have to own these equity producing, cash producing assets, because it's going to give you more options and more flexibility, not just in the present, but also in the long term. And if you have that long term outlook, it's almost impossible to lose in real estate if you have a long term outlook.
Hmm. Yeah, really understanding that if you have $100 today, how much is that $100 going to be worth in 5 years? It's not $100. It's going to be maybe $80 or $90. It's going to be significantly less because the value of the dollar is going down. Inflation is, still higher than it typically is. So really, just to keep the same amount of money today, tomorrow, you really need to be making at least 3 to 4, 5% interest on that money just to be in the same position you are today. So it's not even
Mhm.
a matter of growing your wealth. It's really also just an argument just to protect the existing wealth that you have. And you can't do that by putting it in a 1% savings account at your local bank. You really need to be doing something a little bit more educated and intentional just to protect even what you have today. So that's something
Yeah.
else that people don't talk about that much, but
It's a
definitely keep
great
in mind.
mentality where you want to save, and when I say that, I mean you want to be able to save money based off of the income that you're earning. You want to make sure that you always pay yourself and you're at least saving 20% of your income. But then immediately you want to have a plan with that where you're investing that in something. And my personal strategy is I always try and keep as little cash as possible, other than just typical day to day and emergency fund type expenses in my checking accounts, because while it's sitting there, it's just losing value. Kind of on another note there about your value of the dollar. Right now, I'm reading the autobiography of Andrew Carnegie, one of the American titans and American industrialists from the American Revolution. In his autobiography, he talks about when he was 31 years old was and the difference between an autobiography and a biography is the autobiography is actually written by the person that it's about. So he wrote his own biography, and in this, he writes notes to himself and for the readers. And so, in one of the notes, he's talking about how at the age of 31, he was earning a salary of $50,000. And there was just a personal note in there about how he almost couldn't believe it and kind of how proud he was of himself because he was a Scottish immigrant, came to America with nothing, and at the age of 31, was earning 50,000. And and in 2024, that it's that's not shocking. It's not, we're thinking that's not a big deal. But when you actually look at the time value of money, that 50,000 when he was 31 was the equivalent of 1.5 million in today's dollars. And so just to kind of reiterate that point, currency will go down and the value of the dollar is always going to be depreciating, going down. That is why you need to own cash producing or equity producing assets that are going to rise, and and protect your wealth and increase your wealth.
And we'll do a whole separate episode on just all the tax benefits that make real estate so unique compared to investing in stocks, bonds, just other money market type investments. There really are, when you add all of that up, list out everything, there's so many different ways that real estate investing is benefiting you outside of just maybe what a lot of people are thinking of as the cash flow, the monthly rent that's coming in, any expenses need to be paid. So there's a lot more to it than just the cash flow. And a lot of times people will even have investment properties that are not cash flow positive, meaning they're actually maybe still losing, a couple $100 a month. But because of these other benefits, it still makes an investment strategy that still might be working for some people. So it's kind of understanding that. Before we move on to more specifics on just financing and get some more kind of tips from you, the different types of loans and all that good stuff, I just wanted to share on the researching the market 2 quick tips that have been valuable for me, and I know Ben has used these before as well. So the first one is if you're looking for a property as a not a short-term rental, but a mid or a long-term rental, and just so everybody understands, if it's a rental that's 30 days or less, so under 1 month, that's what's considered a short-term rental. Because of places like Denver that have started to see a lot of restrictions, premiums on people operating short-term rentals, a lot of people now have been moving more into the midterm rental, which is just 30 days plus. A lot of
Yeah.
traveling nurses, different people that might just be considering moving to a city like Denver and want to just do a short 2 or 3 month term lease. These are often also typically furnished units.
Hmm.
Anyways, there are these different types of terms when it comes to short term, midterm, and long term. If you're looking for potential markets to start doing research on, and maybe wanting to go into, for example, just use Tulsa again as an example. You can use a website called rentometer.com. And what
Hmm.
Rentometer will do is it'll actually, you just type in the address of, for example, a property you're looking at purchasing out there. Let's say it's a fourplex and it's 123 Main Street. You type 123 Main Street into Rentometer, it'll give you, 80% of the rentals within a 1 mile radius are $1,200 a month. You type in, what bedroom count it is. It's a 2 bedroom, 1 bath, attached garage, whatever the characteristics of the property are. You just type that in, and it immediately just shares with you all of this great data, just to get a better feel for what that cash flow potential might be in that property. So when you're looking at places out of state, a lot of times you just don't really have a good pulse on what the going rents are. And this is a really
Yeah.
good, easy tool that you can use. It's free up to a certain amount of uses. So definitely check that out. That's a good option just to start getting a little bit more data when it comes to researching different markets.
Yeah, that's exactly right. A lot of this can sound very intimidating. Just buying an investment property, buying your first investment property can be very, very intimidating. I remember when I bought my first, man, it was such a big deal. I was questioning myself, am I making the right decision? Can I really do this? What if this doesn't go according to plan? Am I going to be able to afford the mortgage payment? If I have to make it. And so it can be very intimidating, but that is where when you are willing to take time out of your day and do some of this research. And as you just mentioned, there are so many great tools out there just to allow you to get an idea of what is possible and what is available, and start taking notes, start educating yourself, set yourself up on a home search, see what's available, go to some of those tools that you just mentioned. What would this place rent for midterm? What would it rent for short term? What does the long term rent look like? When I'm doing short term vacation rentals, I consider all those things. And I'll ask myself, what do I think I can rent this for? Or what would this average short term? But if this didn't go really well, and if I had to convert it to a long term, what would that look like? And so I have my primary plan. I have kind of my backup plan. And then I'm also having conversations with local real estate professionals on what are they seeing. Talk to a property manager. That's another great resource. Just have a conversation with a property manager, someone that manages long-term rentals, midterm and short term. And there's a lot of information out there that you can get access to. All of that, what you're doing is you have all of these pieces to the puzzle. Some of it can be found online, some of it can be found over the phone. Others can be through conversations with professionals and mentors. But it is possible to put a very accurate idea of what you can expect together before you actually make a purchase. And it does sound intimidating, buying your first investment property out of state, and it's not going to be for everyone. But I do want to tell you that it is.
Mm-hmm. Love it. And then one other kind of tip or tool I was going to share with you guys is it's called the 1% rule. And this is something that's changed a little bit over time, just with how the home values have been, continuing to rise and are a little bit more of a gap from what it used to be, 15, 20 years ago. But the 1% rule is another kind of a napkin math type thing, just to kind of start keeping in the back of your mind. And what the 1% rule is you basically want to be getting in your monthly rent from an investment property, whatever that
Mhm.
monthly rent amount is, that should be roughly 1% of what you're paying for that property. So if you're buying a $200,000 rental, you should be getting $2,000 a month, which would be 1% of that. In a place like Denver, it's probably down to a 0.5% or maybe even 1/4% in order to really kind of make the numbers work on this part of it. And this is going back to that cash flow piece of this. So,
Mhm.
but just understanding that, there are some kind of simple tools like that just to start keeping in the back of your mind and just using when you start to look at different markets and researching, what rents might be in a certain area compared with what you're finding for the cost of those properties themselves.
Yeah, that is exactly right, and that is why another reason, doing some of that research up front. What can you expect in Denver compared to other markets? And Denver is a market that is probably very pro. If you're buying a home for 600,000 and it's going to appreciate 10%, well, that's 60,000 compared to a market like Tulsa, where if you're buying a home for 200,000 and it appreciates for 10%, it's only 20,000. But what you just said, that 1% rule is going to be very, very challenging to find in a market like Denver because rents have just not caught up with where home values are, where in a market like Tulsa, they have rents are actually way over the 1% in Tulsa. And so it's really identifying, is one piece, one component more important in your personal investing strategy? Is cash flow more important? Are you more focused on equity growth? Are you looking to do something that's short term in nature, as far as like sell the property within 12 to 18 months? Are you looking to buy and hold? And so I am not here to tell you what to do, and I know that you're not either, Adam. But what I do want to encourage you to do is start make sure that you're asking yourself the right questions. You want to ask yourself these questions so you can then formulate a plan on what is going to be the best path forward.
Love that. It's really motivating to hear. So let's just touch on a couple, just again, financing type topics. This is something we could do a dozen podcast episodes on. So just to save you guys from falling asleep here, we just want to just talk about a couple that we are maybe a little bit more personally involved in or just educated about. So the one that I'll share and then I'll pass it back to Ben is just really understanding what we call the BRRR strategy. And this is another Bigger Pockets. I think they are the ones that kind of coined this acronym, but BRRR is just an acronym that's really easy to remember. It stands for buy, renovate, refinance, rent, repeat. So just really quickly going through those: finding an investment property, buying it, that's the B. The first R is renovating it. So buying a property that you've been able to identify has some areas that can be improved in order to increase the
Hmm.
value of the property. So buy, renovate. And then the next one is refinance. So once you've done those improvements, now you're able to go back to the lender that you've gotten that loan on the home through, and you're able to get a refinance done on the home. And hopefully that home is now has additional value. By getting it refinanced, you're able to then pull some of that additional equity out of that investment and use that towards potentially your next investment. So that's that second R. So buy, renovate, refinance. Then the next R is rent. So once you've refinanced and you've gotten it, and you really could probably, those two R's are probably interchangeable. You could rent it and then refinance it, but just understanding this concept of renovating it, getting it refinanced and rented. And then once
Hmm.
you've done that, you're able to repeat. So that's just a strategy that has really worked well with a lot of people, especially at the earlier stages for their first couple investments, just to get that ball rolling and build up some of that momentum. When it comes, though, to the actual financing portion of this and also that refinancing not trick, but that strategy, Ben, I'd love for you just to kind of share a little bit more on both of those 2 points.
Yeah, I would love to do that. And, going back to the Burr method, and this is a great strategy for any strategy when it comes to real estate investing. When you buy right, there's an expression in real estate: you make your money on the buy. And so
Mm-hmm.
when you buy something that is either undervalued or is a very strong buy, or you have room to improve your investment, that is where you make your money. And I see a lot of kind of first time investors, they get too focused on sometimes the property, or they're less focused on if they're buying right, and more focused on some of these other characteristics. And I have even made that mistake myself throughout my real estate journey. Sometimes there's a little bit of an emotional component at times, especially in the short term vacation world, because sometimes these homes will be not just investments, but my family and I will be staying there as well. And so that's the one thing that I have to overcome. And it's like, you know what? This is an investment first, and a second residence second. And so it is when you buy right and you buy under market, or you find something that has room for equity appreciation growth, or being able to improve it through sweat equity, it gives you so many more options, and it's so much easier to win, because then when you do improve it, um, it's going to help with the cash flow. It's going to help with the equity appreciation. So when you go to get the appraisal, you're going to have more options. You may be able to take more out. And, in regards to the financing, on a traditional Fannie Mae, Freddie Mac loan, now that the financing component has changed quite a bit. And one of the updates from this past 12 months is that on an investment like this, you can no longer take cash out that exceeds the sales price if it's been less than 12 months. Before, you used to be able to go straight off of that appraised value. So if you bought something for 200,000, you did improvements and now it's worth 300,000, you used to be able to go off of that appraised value of 300,000, even if it only had been 4 to 6 months. Well, in the traditional investment world, that has changed. It now needs to be at least 12 months before you can go off of that increased appraised value. If it's been less than 12 months, you have to go off that original sales price. Now, there are other programs out there. And at the bank that I work at, for example, North Point, we are also a portfolio lender. So even though Fannie Mae and Freddie Mac changed their guidelines, banks still do have other kind of in-house options to circumvent that. So it still is possible to go off of the appraised value with something like a portfolio loan or possibly a DSCR loan. So there are options out there, but you want to make sure that you're talking to a lending professional that, number one, understands your strategies, but then also has experience doing what you're trying to do. And so, me, if I'm working with someone, I want to make sure that they have experience doing what I'm doing. And
Hmm.
so if you're a real estate investor and you're trying to do a certain type of transaction, my suggestion would be it would be important to work with other professionals that not only offer those things but also have experience personally so they can really relate and identify to what your goals are and what you're trying to do. And at my bank, for example, we have a lot of those different options, and those are also options me personally that I am doing.
That was a really good little point about the 12 months. I actually did not know that. So I'm glad you shared that with us. So outside of using these, other programs that are out there with certain banks and certain lenders, back to just that kind of regular concept of just the refinance. Um, there's really no reason then for an investor, if they bought a property, to have it refinanced before they've owned it for 12 months. So on that side of that scenario, it would really just make sense to wait that full 12 months and then refinance at that point, right? There's no reason to do it. I guess you can't do it beforehand, but um,
You
I don't know,
you
just
you you
do
you
that.
can't do it beforehand with a traditional Fannie Mae, Freddie Mac loan. I mean, technically you can, but to your point, it wouldn't make sense because you have to go off of the acquisition cost instead of the appraised value. There are other options, as I mentioned, but those other options usually, because they are portfolio loans, the financing terms aren't going to be quite as favorable as a traditional Fannie Mae or Freddie Mac loan. And what's interesting is Fannie Mae, Freddie Mac, they kind of catch on to what's happening in the market. And so they kind of caught on to that burst strategy, and then they're trying to put a little bit of a halt to it, and that was one of the big reasons that they made that guideline change. Another strategy that they tried to put a halt to was one of the strategies that I was using, where when you live in one market, and this was something that used to be allowed but it no longer is, where when you lived in one market, you could go buy in another market and you could call it a second home. And the benefit of doing that, so the first home that I purchased in Tucson, actually, I did this. So I lived in Denver. I bought a home in Tucson. I called it my second home because it was. And the benefit of doing that is that you only used to have to put 10% down. But then the big benefit is that you got primary residence financing terms.
Hmm.
And so imagine that. I got the same financing terms on what was a second home slash vacation rental that I could get on a primary residence. And the down payment was very minimal. And so they caught on to that. So what they didn't want doing is investors coming from higher price markets going into lower price markets and buying up all of the inventory, because at that point local home buyers then didn't have the same prospects, because all of the inventory is getting gobbled up by out of state investors. So they changed that. So when it comes to second homes now you have to put at least 20 to 25% down. You no longer get the primary residence financing terms, you get the investment financing terms. So buying a second home out of market in 2024 is not nearly as favorable from a financing terms perspective as it was, 2 or 3 years ago.
Hmm. Really good advice there. I had a friend and a client of mine that owned a investment apartment in Boulder here in Colorado recently that he sold. And another thing to keep in mind if you are going to be selling an investment property is there is a tax that is applied to out of state owners of real estate. So, for example, his primary residence was outside of Colorado. So, when he sold this investment property in Colorado, he actually had to pay a 2% tax on the final sales price of the investment properties. That could
Mm.
easily, add up to a significant amount of money. I think about when I lived up in Aspen in these homes up there that people are frequently selling, and they're almost always out of state owners, in those situations. A $20 million house, that's a lot of money, $200,000 just on the tax that they're paying. So it's kind of interesting to think about.
Yeah, imagine that, and learning about transfer taxes and all of these different costs and kind of how the real estate side works.
And maybe just one last little question I have on mind for you, Ben, and then we'll wrap this episode up. Is just with traditional real estate, I've got buyers that are either first time home buyers or just anybody that's a serious buyer for their primary. One of the biggest, most important things to do is to get pre-approved. That way, you have this ability to not only know accurately what you're looking for as far as price points, but also you have some leverage when it comes time to place an offer on a house and show
Yeah.
that you're pre. When it comes to, we'll keep this on the small multifamily side. So if you're looking to buy an investment property of 1 to 4 units, how does the pre-approval process work with a lender in that scenario?
Yeah, that's a great question, and the answer is it's going to be very similar to a traditional mortgage application. What I do when I get scenarios like this in applications, I always encourage my applicants to apply online. That way, they can fill out their information, and we know that's going to be 100% correct. So the application process is always a two-step process. The first step is the individual applicant filling out the application. The second step and pulling credit. So the credit pull is part of that. And most lenders, like us, we do have the ability to do a soft pull. So if you have any concerns about not wanting to have a hard inquiry, the soft pull, what's great about the soft pull is that it gives you all of the same information. It gives you the credit scores, all the trade lines, your balances, your payments. And so most lenders do have the ability to do a soft pull. So if you don't want to have a hard inquiry on your credit, just ask your lender about a soft pull. And then the second step is gathering all of the financials that are associated with the application. So for someone that is an employee, we would grab their W-2, their pay stubs, all of their financial accounts, their bank statements, their investment accounts. If they're self employed, we'd get their personal and their business tax returns. And then we would get an idea of what they're looking to purchase. Now, what's great about when you purchase an investment property, and this is what a lot of people don't know, is that if your intent is to buy a property as an investment, whether it's a single family, a condo, a townhome, or a multifamily, when the lender orders the appraisal, they're actually going to order two appraisals. The first is in regards to the market value of the property, and then the second is in regards to the market rent. And so, even if the property you've identified is vacant, your lender still allows you to count whatever the market rent is. So if the market rent is $3,000 a month, you can use 75% of that towards income, even though the home is vacant. And what that does is usually that will offset all or the majority of the mortgage payment. And so it really, really helps from a qualifying perspective because as your intent is to rent the property out, the lender knows that's what you're planning on doing, and so they will actually allow you to count that market rent, 75% of it, towards your income. And so that can really, really help with qualifying. And then when we send out the pre approval letter, we'll put that on there. We'll put that on there that this individual is pre approved for this much, X amount sales price. So $800,000, for example, is going to be putting, 25% down. And these are the documents that we have received and reviewed: credit report, driver's license, pay stubs, W-2s. And so, and then anything else. And then when you send that to the seller, what you're communicating to the seller is that this individual is well qualified. They have had their credit pulled. They've turned in all of their financials. All of that has been reviewed by a mortgage professional. And so there's a lot of kind of misunderstanding about the difference between pre qualification and pre approval. And one mistake that I see a lot of lenders make is that they will just, pre-qualify. You just pull someone's credit and you go off of whatever they put on the application without actually collecting anything. But it's a critical, important step. And in my mind, and in my opinion, it's irresponsible as a lender not to do those things because, someone might say they earn X amount of dollars. Well, I'm self-employed and I earn 10 grand a month. Well, you're self-employed and your revenue is 10,000 a month, but your net
Hmm.
income is actually $3,000 annually. That's why you have to do that due diligence up front.
Hmm. That's great. Yep. Once again, all comes back down to just being educated and prepared. So when that time comes and you find the right investment, you're ready to go and you're not missing out on opportunities because you haven't done the due diligence and just this front end work that is really required to have a strong investment where you're hopefully going to make some money on it.
Yeah. Yeah, and to your point there, I mean, there are so many different ways to do the financing piece, and I just wanted to touch on this really briefly before we signed off. What we've been talking about is more traditional financing, doing a Fannie Mae, Freddie Mac, 25% down loan, which can be a great and an appropriate option. One of my favorite strategies, though, I believe that if you own real estate and if you have equity in that real estate, whether it's your primary residence, an investment property, or anything else, it is very important to have a home equity line of credit on that property. There's a lot of different home equity lines of credit out there, but by doing that, you have immediate access to your home's equity. Now, some people might disagree with this, but it really depends on what your personal strategy is. This is a strategy that I use. And the reason that I have home equity lines, I have home equity lines of credit on multiple properties. And the reason is, you know, fivefold. One reason is it provides another layer of financial security. The fact that I have all these different home equity lines of credit set up, if there ever was a big financial event that happened with one of these properties, I would have the means to essentially grab that from my home equity line. I'm already approved, I already have access to it, and I can go pay for it. So it really reduces my risk. But I'll also use it for investing as well. There's been times where I've taken money out on a home equity line and gone to pay cash for a property because I can then make a more competitive offer. I can make it cash. What I'm really doing is just self financing. I'm
Hmm.
borrowing the money from myself, paying cash for this. And then what I do after is I then refinance that and then open my equity line back up. And then I can kind of repeat the process. So you were talking about the BRRR method earlier. This is a process that I use using the equity lines to go pay cash for things, pay cash for something using the equity line, get it refinanced, and then you can go repeat again. And so
Hmm.
once you have equity in some properties, it's a great way to have the ability to scale. Also, there's commercial loans, which we haven't really spoke about, and commercial loans are a little bit of a different animal. But I also have commercial loans as well on investment properties. Commercial loans aren't going to show up on your personal credit report, and what the commercial bank is going to be looking at is really more what you would expect from your experience in the commercial world, where they're really going to be focused on that cash flow for the property and the income producing piece, and is it going to be able to support itself based off of the rent compared to the expenses. And if it is, a lot of times they'll be willing to lend. Typically down payments are going to be higher on that, 25 to 30%. But the point is that there's all these different options out there. You can go the traditional method. You can go the residential method. A lot of lenders have DSCR options. There's commercial options. You can learn how to leverage your equity that I was just talking about. So there's no right or wrong way to go about this. The right way is figuring out what way is right for you, developing a plan, making sure that's in line with your vision, and then being able to execute. And if you don't understand something or you want to bounce ideas off another professional, like, that's important. Call someone, call myself, call Adam, and we'd love to, have those conversations with you.
Yeah, another one that you didn't mention that maybe we can do a separate episode on because it's such a popular talking point with a lot of large multifamily investors right now is these self-directed IRAs. So if you have a traditional job, a salary type job, and you've got benefits where you're getting a K,
Hmm.
basically just the ability to take that money and actually apply it towards an investment, such as a real estate investment trust. We can kind of dive deeper into that later on too if we need to.
Yeah. Yeah, and there's also real estate syndicates, which are becoming more and more popular, I feel like, in the commercial world. So I'd love to, learn more about that myself. And, you're probably very experienced with that as well, just from your experience. So,
Cool, guys. Well, hope we got some value out of this. Again, just trying to give you some more realistic stories, action items, just ways that you guys can take some intentional steps now towards making this a reality if this is a goal of yours. So, hopefully, you guys got some value out of this. Stay tuned for next week when we're going to go even further down the road of real estate investing and talk about some other very important parts of this process. You guys really enjoyed this episode today. Ben, I'll let you close us out.
Thank you again, everyone, for joining us on another episode of the Pursuit of Progress podcast. Until next time, Benjamin Adams signing off for Adam.
See you guys.